So moomoo has this list of the most popular stocks in the Singapore market. However, just because a stock is popular doesn't automatically make it a good investment. Sometimes it simply means that people are chasing hype. So in today's video, I want to take these most popular Singapore stocks and rank them from elite to good to meh and finally to avoid. This ranking is based on fundamentals, long-term stability, and the kind of business each company actually runs. Some of them are the kind of stocks you can hold for years without worrying, and some of them, well, not so much. And to be clear, this is not financial advice and is for educational purposes only, yeah. Alright, let's start with the three big banks, DBS, OCBC, and UOB. When you look at the latest bank earnings, what stands out is how differently the same macro environment treated these three banks. For DBS, it was yet another solid quarter. The bank reported a net profit of $2.95 billion for Q3 2025, once again beating estimates and pushed its share price to yet another all-time high. And even though its net interest margin dropped to 1.96% from 2.11% a year ago, its total income climbed to a record $5.93 billion, largely thanks to strong wealth management revenue and deposit growth. On top of that, DBS declared a one-tier dividend of 60 cents a share, along with an additional one-tier capital dividend of 15 cents per share, bringing the total payouts to 75 cents. A year ago, this figure was just 54 cents. This increase signals confidence in the bank's capital position and in its long-term commitment to shareholder returns. For OCBC Bank, the quarter was not bad either. OCBC posted a net profit of $1.987 billion, which was almost identical to the same period last year. The difference came from OCBC's strong boost in fee-based income, particularly from wealth management and private banking. OCBC's net fee income rose to $683 million, with wealth management fees alone jumping by around 35%. This shows that OCBC's wealth franchise continues to grow strongly, supported by strong inflows into the bank and a growing base of affluent clients. Then there's UOB. Unlike the other two banks, UOB had a rough quarter. Its net profit plunged 72% year-over-year to $443 million. This happened because UOB took on a large $1.36 billion in credit allowances, including a $650 million general provision, which the bank says is to strengthen its balance sheet against potential loan losses. This is quite surprising given that DBS and OCBC have no such problem. So what happened was that there was a big increase in non-performing loans, particularly from China and the US. For China, its non-performing loan ratio has increased from 2% last year to 3.1% now. And in the United States, it has increased from 2.4% to 4% now. However, this does not mean that UOB is a bad bank. It simply means that UOB chose to be conservative and take the hits up front, instead of waiting for the problem to grow bigger. Its CET1 ratio is still healthy, which shows that the bank remains well capitalized. It also has a sticky deposit base that gives it stability, and its regional franchise continues to expand after the Citi Southeast Asia acquisition strengthened its presence in markets like Malaysia, Thailand, and Vietnam. Its wealth management business is still growing, and its cost-to-income ratio is still among the best in the region. So this quarter looks more like a short-term headwind than a long-term structural problem. And when you look at the bigger picture, Singapore banks continue to be some of the safest and strongest in the region, with stable earnings, prudent risk management, and consistent dividends. Because of that, I will place all three banks in the elite tier. Yes, even UOB. The short-term stumble does not change its long-term fundamentals. If anything, I still believe that UOB sits alongside DBS and OCBC as one of the most dependable long-term holdings in the Singapore market. Quick pause. If you want to assess whether a company is worth investing in or not, a great place to start is the moomoo app. For example, you can get a quick overview of a company's valuation level with moomoo's company valuation tool. With this, you can quickly assess whether a company's current stock price is cheap or not. You can also check out analyst ratings to see what analysts think about the company, along with detailed explanations of their ratings as well as their track record. For additional insights, you can check out Morningstar Research. This is a paid feature, but it's available for free on the platform. It is one of the main sources I rely on for doing investment research. Moomoo also supports CTP linkage now, which allows you to purchase Singapore stocks through your CTP account at a much cheaper rate as compared to other traditional brokers. New users who sign up to Moomoo SG will get to earn up to $1,315 worth of welcome rewards when you fulfill the terms and conditions, which includes a $60 worth of Nvidia shares, plus participate in a guaranteed lucky draw to win a gold bar worth $1,500 if you link your CTP account. You will also enjoy zero commission for US, Hong Kong and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. Simply follow the steps below and key in my promo code Kelvin88 to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. Next, we have Singapore Airlines, and this is where we need to separate sentiment from fundamentals. SIA is a world-class airline with an incredible brand. It delivers great service, has strong customer loyalty, and represents Singapore on the global stage. But being a great airline does not automatically make it a good stock to hold long term. The challenge with SIA comes from the nature of the airline business itself. It is highly cyclical, capital intensive, and extremely sensitive to fuel prices, global travel demand, and macro shocks. Even in good years, SIA's profit margins tend to be thin, and any disruption can wipe out earnings very quickly. We saw this clearly during the pandemic, when SIA had to raise billions in rights issues and mandatory convertible bonds. On top of that, the company needs to constantly spend large amounts on fleet renewal, aircraft maintenance, and fuel hedging. These costs will never go away, even when revenue slows down. And even today, in a year when people are traveling more, SIA's earnings still fell sharply. In the latest quarter, SIA's profit plunged by 82.1% year-over-year, weighed down largely by losses at Air India. So while SIA is a fantastic airline, it is not a stock that rewards long-term shareholders consistently. Because of this, I will place SIA in the avoid tier. It can perform well in certain years, but as a long-term investment, the risk and volatility far outweigh the reliability that most investors are looking for. Now, let's move on to Singtel. This is a company that almost every Singaporean recognizes. But for many years, Singtel went through a long period of stagnation. Competition in the telco space intensified, legacy revenues declined, and several of its overseas associates faced headwinds. But then, over the past couple of years, Singtel went through a strategic reset. It expanded into regional data centers through its Nexera platform, strengthened its cloud and cybersecurity offerings, and streamlined legacy operations that were dragging performance. One clear example was the divestment of Amobi and Trustwave, two of its non-core digital businesses that had been posting losses for years. By exiting these segments, Singtel removed a major earnings drag and redeployed capital into higher growth infrastructure and enterprise services. This reset is starting to show results. In its latest half-year numbers, Singtel reported an underlying net profit of $1.35 billion, a 14% increase from the previous year. Regional associates such as Bharti Airtel also contributed strongly, while its digital infrastructure and enterprise divisions continued to gain traction as demand for data storage, cloud connectivity, and digital transformation rose across Asia. Singtel even raised its interim dividend to 8.2 cents per share, compared to 7 cents previously, supported partly by proceeds from its asset recycling strategy. So, while Singtel is not a fast-growing company, it is clearly in a healthier and more forward-looking position than it was a few years ago. It has stronger earnings visibility, more diversified revenue streams, and a clearer roadmap for sustainable growth. Because of that, I would place Singtel in a good tier. It offers decent stability, improving fundamentals, and a strategy that aligns with where the industry is heading. However, its core mobile business remains competitive, regional markets can be unpredictable, and the data center expansion carries execution risk. Next up, we have Sheng Siong. Sheng Siong is a classic neighborhood supermarket chain, and that positioning has been one of its biggest strengths. It focuses on essential goods, keeps price competitive, and runs a very efficient supply chain. In other words, this is a business that wins by not being flashy, but by being consistently reliable in meeting everyday needs. Its revenue and profit have been stable, cash flow has remained strong, and the company continues to maintain almost zero debt. While many retailers struggled with rising costs, Sheng Siong managed to protect its margin better than expected, thanks to tight cost control and a business model that does not rely heavily on costly expansions or risky acquisitions. One thing I always like about Sheng Siong is its conservative approach. Sheng Siong does not try to grow for the sake of growth. It opens new stores only when it makes sense. And this is exactly why the company has been so resilient. During uncertain economic periods, while other companies reported volatile earnings, Sheng Siong continues to attract consistent demand simply because people always need to spend on groceries and toilet paper every day. This stability is also reflected in its dividends, which have been paid out every year and have generally trended upward in line with earnings. Not only that, its reputation for affordability and strong promotions naturally attracts more shoppers in those times, which helps to support its sales even when the broader retail environment is weak. So, given its stability, strong execution, and ability to deliver dependable returns over time, Sheng Siong firmly earns a place in the elite tier. Moving on, we have Sembcorp Industries. Sembcorp is a Singapore-based energy and urban infrastructure group with businesses that range from gas-fired power plants and utilities to water treatment industrial parks and a growing portfolio of renewable assets such as wind and solar farms across several countries. In recent years, Sembcorp has been repositioning itself away from its older fossil fuel footprint and toward renewable energy and decarbonization solutions. This means building and acquiring clean energy capacity so that a larger share of its profits comes from sustainable energy rather than from its traditional power businesses. This strategy has so far delivered some encouraging signs. In the first half of 2025, the renewables segment reported a 27% increase in net profit compared with the previous year, driven by the continued expansion of wind and solar capacity in markets like India. However, if you look beyond the headline numbers, you can see that Sembcorp faces many challenges, many of which are not entirely within its control. Take, for example, its legacy gas and power operations, which still make up a large part of the business. Profit from this segment came in lower than a year ago. One major reason was the steep decline in wholesale electricity prices in Singapore. The uniform energy price fell about 39% year-on-year, which compressed margins for power generation. At the same time, the company had to bear higher costs of sourcing green power imports, which also weighed on its profitability. As for the renewables segment, which is supposed to be the company's future growth engine, it has not been entirely stable. In markets such as China, some projects faced higher curtailment, where the grid was unable to take in all the renewable energy produced. Tariffs were also lower because renewable supply was growing faster than demand, and ongoing market reforms changed pricing structures. Together, these issues made earnings from renewables quite unpredictable. Another issue is the volatility in foreign exchange rates. As Sembcorp expands into several international markets, currency swings can have a meaningful impact on its reported results. For example, when the Indian rupee weakens against the Singapore dollar, the profits earned from Sembcorp's Indian wind and solar projects are reduced once converted back to SGD. When you put all of these factors together, along with the capital-intensive nature of its renewable expansion, it has led to dividends that can be quite unpredictable from one year to the next. In short, while Sembcorp's green growth story may sound exciting, the reality is that the company is managing many moving parts, each with its own risk. And once you weigh the potential against the volatility in earnings, the execution challenges, and the lack of consistent dividends, I view Sembcorp as a stock that belongs in the meh tier. Next up on the list, we have Seatrium. Seatrium is Singapore's large offshore and marine engineering group, formed from the merger of Sembcorp Marine and Keppel O&M. The company specializes in building offshore platforms, wind installation vessels, and various types of marine infrastructure. While the business sounds promising in theory, especially as global energy demand shifts and new offshore projects emerge, the reality is that the company is in a very challenging environment. The offshore and marine industry has been affected with cyclical downturns, rising costs, and an oversupply of shipyards around the world. And Seatrium has inherited many of these issues, including legacy contracts, a long history of losses, and a balance sheet that has gone through several repeated rounds of restructuring. Even after the merger, the company continues to face cost overruns and execution delays, which are common in large engineering projects where margins tend to be very thin. One of Seatrium's biggest challenges is that its earnings are still closely tied to the oil and gas cycle. When energy companies slow down their capital spending, new orders dry up, shipyard activity falls, and this affects Sembcorp's profitability. Not only that, even in stronger periods, the company recognizes revenue only when specific project milestones are completed. As a result, its financial performance can fluctuate significantly from quarter to quarter. Another concern is dilution. Over the past decade, shareholders have faced multiple fundraisings, which significantly increased the number of shares in the market and diluting the ownership stake in the process. The shift toward renewable energy solutions, such as offshore wind, does give the company some new opportunities. However, competition in this space is intense, with many global shipyards already fighting for the same projects. These contracts also carry their own risks, such as rising material costs and changing technical requirements, many of which can affect profitability. So, given all these uncertainties, from project execution risk and industry cyclicality to the long history of losses and shareholder dilution, it is simply easier for investors to choose other companies that has a more consistent track record and steadier growth. For that reason, I place Seatrium in the avoid tier. Next on the list, we have ThaiBev. This company is one of Southeast Asia's largest beverage groups, best known for its Chang beer, as well as a wide range of spirits, non-alcoholic drinks, and food businesses across Thailand, Vietnam, and the region. Given the nature of its products, you might expect demand to be fairly resilient, where people continue to buy beverages regardless of the economy. But the company's results in recent years have been a mixed bag. A big part of this comes from Thailand itself. The Thai economy has faced slower growth, softer household spending, and political uncertainty, all of which have led to weaker consumer demand. Similarly, although Vietnam is meant to be a major growth driver through the company's stake in Sembcorp, progress there has also been inconsistent. Competition has increased and demand has been growing much slower than expected. Because of this, the overseas business has not been able to offset the challenges in Thailand. Another area of concern is debt. Over the years, ThaiBev has accumulated significant borrowings, particularly during its expansion phase. This was easier to handle when interest rates were low, but in today's higher interest rate environment, it limits the company's flexibility to invest or return more capital to shareholders. The proposed listing of its beer business could have been a clear catalyst, but the plan has been postponed multiple times, leaving the timeline uncertain. Earnings growth has also been sluggish, and while its dividends are stable, it is not particularly attractive, especially when the company does not have meaningful growth drivers on the horizon. So while ThaiBev is a familiar name with well-known brands, the combination of slow growth, uneven consumer demand, high debt, and unclear catalysts makes it less compelling than other consumer companies. For these reasons, I place ThaiBev in the meh tier. Lastly, we have Singapore Exchange, or SGX. SGX operates the country's only stock exchange and plays a central role in Singapore's financial markets. Its business spans equities trading, derivatives, indices, market data, and clearing services. One of SGX's biggest strengths is the stability of its revenue. A large portion of its earnings comes from derivatives trading and clearing fees, which tend to be more resilient as compared to equities trading. Even when the local stock market is quiet, global uncertainty can drive higher derivatives activity, which supports SGX's performance. This is why the company has been able to deliver consistent profits and maintain a relatively strong return on equity over the years. SGX has also been working to diversify its business. It acquired index providers, expanded its derivative suites, and formed new partnerships to grow the fixed income and foreign exchange markets. These efforts have helped to reduce its reliance on equities trading, which has been slow in Singapore due to limited retail interest and fewer IPOs. While these diversification steps have not created explosive growth, they do provide a more stable base that investors can depend on. That said, SGS does face some limitations. The Singapore equity markets remains small compared with major global exchanges, and attracting large high-profile listings continues to be challenging. Trading volumes can be sluggish, and this creates a ceiling on how much growth SGS can achieve on the equities side. However, on the bright side, there have been ongoing efforts by SGS and MAS to rejuvenate the markets, including measures to attract more listings, deepen liquidity, and encourage participation from both institutional and retail investors. But these initiatives will take time to bear fruit, and the structural constraints of a small market remain hard to overcome. In short, while SGS may not be the most exciting stock on the list, it does offer some form of reliability, strong market positioning, and predictable performance. Because of that, I will put SGS in the good tier. So there you have it. Those were the most traded Singapore stocks on moomoo, and how I would rank them based on the fundamentals, growth prospects, and overall consistency. Anyway, that's all for this video. Like, share, and subscribe as I'll be posting new videos every week.